relevant and will benefit other members. This afternoon, we're privileged to welcome Jital Solanki, Senior Manager at BDO Australia. Jital is the Senior Manager in the Transfer Pricing team at BDO Sydney. Jital is a tax professional with 11 plus years of experience in various areas of income tax and handles a large portfolio of Australian and multinational clients at BDO. Prior to joining BDO, Jital worked in corporate international tax environment in India at one of the big four accounting firms. Also dealing with transfer pricing policy planning, transfer pricing documentation, value chain transformation, and planning country by country reporting. So please welcome Jital Solanki.
Thanks, Teddy. Thank you everyone for joining, and yeah, it's nice to kind of come here and talk about a very specialized sort of area of tax, transfer pricing. Yeah, so as Teddy mentioned, yes, I'm a senior manager with BDO, specializing in transfer pricing, working with a number of smaller, larger Australian businesses, multinationals, on a host of transfer pricing matters. At BDO, in Sydney, we've got a team of 15, so it's a pretty decent practice. I'm not sure how much, in terms of the news that's been followed, but transfer pricing has been quite a hot topic in recent years, which basically means the ATO is quite interested in all things transfer pricing, which means, we're quite busy at BDO transfer pricing, helping our clients. So very happy to be here sharing probably an overview of transfer pricing today, just some sort of touching upon some basic concepts and key developments in the space in the past couple of years, and talking about some of the areas that the ATO is interested in. So when you all sort of come across a matter that relates to a transfer pricing issue, it can probably serve as a reminder that, oh, this could be potentially a transfer pricing risk, which probably needs to be discussed with the transfer pricing professional. So yeah, I guess as I mentioned, just sort of a very high level overview. Key focus area of the ATO. You may have heard of something called the Justified Trust Program. The ATO's received a lot of funding to one of the agenda items, I guess, from the government perspective, is to make multinationals pay their fair share of tax. And part of that is the Justified Trust Program and a lot of focus and attention to transfer pricing, because it relates to transactions between related parties. So there seems to be an impression that there is a way to manipulate outcomes to be able to achieve lower tax outcomes in Australia, which is why the ATO is quite focused on this topic. Just as an overview, in the recent in terms of what we've been hearing from the ATO and some of the statistics that are coming out, which are available in public domain, a lot of the when it comes to statistics from ATO reviews and audits, transfer pricing adjustments tend to be in the top when it comes to the ATO being able to collect more taxes from mainly multinationals. So it's definitely a focus area. We've been bombarded with a lot of guidance as well, in the form of taxation rulings, practical compliance guidelines, and so on and so forth, which basically keeps us busy and making sure that our clients understand what they're dealing with and what are the risks, and how does the ATO review them from a risk perspective. So yeah, I might just go. That's probably our agenda for the day. So we're going to look at some key transfer pricing concepts, so starting with the very basic. Then we'll get into looking at what is the information that taxpayers provide, which then the ATO takes and then assesses a taxpayer. So to be able to identify what are the risk areas. We might then delve into the topic of significant global entities, which has been a pretty hot topic since the introduction back in 2016. And then might just leave you all with a few takeaways for you to, in future, when you come across a transfer pricing issue, it might just be a good reminder to consult with a specialist in the area. All right, so I might just start with the overview. So yeah, just sort of going into basically what is transfer pricing. Transfer pricing really is when there's a pricing of a cross-border supply of goods or services or any other type of interaction between parties. And because the legislation refers to cross-border, so it's generally when it is, Australia with an overseas, with party which is overseas. And typically relevant when it is related parties, because that's when the concept of arm's length pricing and all of that comes into play. So it's typically, you'd see that essentially between entities that are part of a multinational group. Let's say there's a head office with a number of subsidiaries around the world. So how those subsidiaries or all the entities of that group interact with each other. When they transact with each other, let's say they provide services to each other, there's a supply of goods or any other type of support to each other, how that is priced is essentially what transfer pricing is. From a global perspective, there's obviously, it's not just the ATO that's interested, it's tax authorities all over the world. Australia being an OECD country, we adhere to a lot of the concepts and the guidance that comes from the OECD. So we do have OECD guidelines that are also part of the Australian transfer pricing legislation. And that does try and kind of standardize some of the concepts and expectations from taxpayers. However, having said that, when the ATO, every revenue authority is interested in expanding the tax pool and the tax base, so that's where there's a bit of it's a bit of a balancing act between, let's say, when we deal with a client, a taxpayer that's an Australian entity, and then transacting with an entity overseas. So we've got the ATO that's interested in making sure that the entity pays the right amount of tax in Australia, but we've also got an overseas tax authority with the same objective on the other side. So when it comes to transfer pricing, it's all about finding that right balance between the expectations of the tax authorities in different jurisdictions. And the way we do that is ensuring that we follow the OECD guidelines, which apply to most of the jurisdictions adhere to. So it does bring some sort of standardization in terms of how should transfer pricing work in a certain scenario for a certain entity of a multinational group. When it comes to the legislation, unlike a lot of the other tax legislations, we only have one subdivision 815B, which is pretty much, there's also subdivision 815C, but for the purposes of majority of the things we would discuss today, subdivision 815B of the ITAA 1997. That's just one subdivision, which pretty much is the transfer pricing legislation. There's also, so it's a pretty short piece of legislation in that sense. So we don't have a really long legislation or not a lot of sections to look at. And I mean, I guess the main reason is because transfer pricing is very much based on facts and circumstances. So we're always going back to what's actually happening on the ground and in substance. Which is why all the legislation does is refers to facts and circumstances. Apart from 815B, we've got documentation requirements from a transfer pricing perspective, which for which we've got subdivision 284E of the Administration Act 1953. So that's what we refer to when we look at what's the ATO's expectations in terms of how taxpayers should document their transfer pricing arrangements. So yes, so I guess we've covered basically what's transfer pricing, the global landscape, and the Australian legislation. Now, apart from the legislation, as I mentioned previously, we've got a lot of practical compliance guidelines that the ATO issues from time to time on various topics. We've got taxation rulings, taxpayer alerts. So it's not there's the legislation, but there's all these other pieces of guidance that comes from the ATO that and when we look at it, we look at it all holistically. And there's been I guess in the past few years, there's been a lot of guidance by the ATO on different topics. So which has kind of kept us busy with interpreting and understanding how that's going to affect taxpayers. You might see this chart, this like diagram is pretty much kind of explains the relationship and what the ATO would look at as a transfer pricing benefit. So transfer pricing benefit is what's referred to in our legislation. So you'd see here there's an entity, let's say entity in Australia, there's an entity overseas. If Australia, let's say, makes a payment to an overseas entity for which it claims a tax reduction. So if that expense is higher than what it should have been, then that means that you're taking an excess deduction in Australia, which obviously means that that results in a lower tax outcome from an Australian perspective, which is obviously something that's a concern. The other way around, when there is income coming into Australia, if that income is underpriced, which means the income is lower, which would also mean lower taxes being paid in Australia, which would also be a problem from a transfer pricing perspective. So when we look at transfer pricing benefit, it's really, and this is all that's referred to in the legislation, lower taxable income or a higher loss amount as well. So anything that results in a higher loss in Australia than what it should have been. Higher tax offsets. Again, you eventually pay less taxes or a lower withholding tax payable. So when any of this happens means that it could be a result of a transfer pricing benefit. Now, if it is a result of a transfer pricing benefit, then that's where the transfer pricing rules come into place, which basically prevent you from obtaining a transfer pricing benefit in Australia. Now, what typically you'd see the type of arrangements which companies in Australia deal with, where there are transfer pricing issues. Provision of goods, yes, because Australia, there's a lot of distributors that we import a lot of goods from overseas. So there's import of goods where you'd see a lot of transfer pricing issues. Services between related parties. So there's an Australian entity, overseas entity. They've got transactions in terms of one entity providing services to another entity, which again means what's the value, what's the price of that service, has it been priced appropriately, which could again be a transfer pricing issue. Financing and loans in general, there have been some case laws on this as well, because Australian taxpayers tend to be a leveraged economy. So we do tend to have a lot of inbound loans in Australia, which again means you're going to take a deduction for the interest cost on that. So again, which means a higher deduction would mean a transfer pricing benefit. So another one where the ATO is interested. Recharges, a similar concept, when expenses are being recharged back into Australia, meaning a higher tax reduction in Australia, which again could result in a transfer pricing issue. So, so I guess overall, transfer pricing is all about following the legislation, making sure that when there's a transaction between related parties, and a cross-border transaction, so which is Australian entity dealing with an entity overseas, it is being priced appropriately. And when we say appropriately, a lot of it goes back to how would independent, unrelated parties have priced that particular transaction. And that's how the legislation requires a taxpayer to price it even when dealing with a related party. So that's what we call pricing it as at arm's length. So as if the transaction is at arm's length. So any related party transaction needs to be priced at arm's length. That's really what the legislation asks us to do. And that's really what we're trying to achieve. And where it's not at arm's length, that's where there's an issue. And if that results, if that transaction that's not at arm's length actually results in a transfer pricing benefit, which means basically lower taxes being paid in Australia, that's when the ATO would have a problem. So that's what we need to be careful of. And that's what we do as transfer pricing professionals, make sure that any transaction between related parties are priced appropriately at arm's length. So that's what we're trying to achieve. I guess that provides a very high level overview of what transfer pricing is. As I said, the legislation is quite simplistic. It goes back to facts and circumstances. It goes back to determining how unrelated parties would have dealt with that particular situation in an arm's length scenario. And that's what you're expected to do as a taxpayer. And then when it comes to documenting that, that's where the Section 284E comes into play, where the ATO expects that pricing, the way it's being done, and to show that it's being done at arm's length, to be documented in a certain format. So they can actually, if they review a taxpayer, they can actually see what the taxpayer's done to show that this is actually at arm's length and there's no mischief from an Australian perspective. I might move on just to the next slide. So I won't spend too much time on this slide. It's pretty much providing just an overview of old rules, transfer pricing rules, which was Division 13, whereas the current regime, which is the Section 815B that we're dealing with, this overhaul, the changes took place about in 2014. In a nutshell, the old rules was transfer pricing was a commissioner's determination, whereas the new rules put a lot of emphasis on taxpayers. So it is a self-assessment regime, which basically means the taxpayer, when a public officer of a company or when a public officer signs a tax return, public officer needs to ensure that the transfer pricing arrangements are actually in line with the legislation, which basically means they're priced appropriately. And that's the onus on the taxpayer, as against under the old rules where it was the commissioner who would come and review a taxpayer and would have to prove that there was a transfer pricing benefit. Other than that, I guess the other big one is under the old rules, there was no statute of limitation, whereas under the current rules, there is a 7-year statute of limitation, which basically means the ATO can review arrangements only up to 7 years. So it's probably, it's a good thing. And then the old rules did not have reference to the OECD guidelines, whereas the new rules do have reference to the OECD guidelines, which is good because we do want consistency with the rest of the world. So that's good to have. I might just jump to the next one. So this slide just gives you a very, I guess, a high-level overview of how the transfer pricing space has sort of developed over the past 10-ish years. So there's back goes from 2013, this slide. So basically OECD starts to look at making sure that there's no profit shifting, and then all the countries and all the taxpayers are paying the right share of taxes in relevant countries. So that's where was the OECD BEPS program. Then we had the transfer pricing legislation, the new rules, the subdivision 815B come into play in 2014. We had something called significant global entities, so the SGE that you see on the slide, CBCR, country by country reporting entity. This is again a global this is a global piece which was also adopted in Australia. So those rules came into play about 2015, 2016. We've got two anti-avoidance laws specifically that apply to SGEs, which is the MAL and the DPT. Then we had the tax avoidance task force being set up, which was basically to ensure that all the multinationals pay their fair share of taxes, which kind of links into a lot of the transfer pricing issues that we would look at today. Then the ATO started issuing practical compliance guidelines that I was just telling you guys about, that the ATO started to provide their view on a number of transfer pricing issues, which basically meant taxpayers needed to then go and see, okay, this is how the ATO is viewing our arrangements. And it goes to the next point there on the screen, that is ATO encouraging behavioral-based transfer pricing. And they have said this to us in a number of forums, in conferences as well, that they want to bring a shift in taxpayer behavior. So by issuing a number of guidelines in terms of what their view is on certain topics, what they're trying to make sure is that taxpayers understand and eventually, hopefully, adopt what they expect from them. So I guess, yeah, this is pretty much, so as you can see, it's been a very active space from an ATO perspective. What's not here is the number of transfer pricing issues that have been picked up for ATO reviews, audits, and the like. So that's obviously gone up, as well as the ATO's focus on these issues has gone up in recent times. So I guess this is sort of a continuation, and this is just the very, very recent developments that have taken place in the transfer pricing space. So there's a few topics that the ATOs they have said they're particularly interested, and they have mentioned this publicly. One is the topic of intangibles, and that's because the ATO believes that a lot of Australian companies that start in Australia, they're more in the startup phase. A lot of the brand development takes place in Australia, and then the migration happens to another jurisdiction. So that's been a big concern of the ATO, because obviously a lot of the value of that brand then gets shifted overseas. And then any future income that's generated from the exploitation of that brand also sits overseas. So that revenue does not come back to Australia. So it's been a very, very live topic, and they've issued last year a PCG on this, which is a very important consideration for all our clients at the moment. Especially relevant when what I've seen in terms of my time at BDO is like a lot of the Australian startups that eventually then get acquired by overseas parents, as they get overseas entities like PE funds, or just another entity that decides to acquire them globally. And then that's where this IP issue comes up, and the ATO is sort of well aware of that. That's why they've issued a lot of guidance in this space. Next one, I guess we've had some cases transfer pricing related. So there's on financing, we've had Singtel. There was another case called Chevron, which some of you may have heard of in the papers. It was a big deal. We've recently had the PepsiCo case, which deals with royalties and withholding tax. And there was also the Mylan case. So we weren't used to having a lot of transfer pricing cases in the past, but in the last few years, again, a lot of transfer pricing issues have come up, and they're all sort of now getting to a level where, they're the full federal court level, where we're getting decisions from the court, which is a good thing, because then we can see, it sets a precedent, and then that provides a bit of certainty from that perspective. The next one, we've got BEPS 2.0. So there was the BEPS that we saw in the previous slide, which was back in 2013. We've now got a 2.0 version, and that's mainly because tax authorities all over the world realize that with digitalization and remote working and revenue being generated through online businesses, it's very hard to allocate revenues or profits to certain countries, or that it's important to align revenues with where the value is being generated, which is why this is a fairly new initiative from BEPS, and obviously Australia, being an OECD country, has adopted the program. So I guess you may have heard of the global minimum tax of 15%, which isn't really a big problem from an Australian perspective, given our tax rate, but it's definitely something that's affecting a lot of the Australian multinationals. And there's a bit of compliance that's going to come in to provide some sort of information to the ATO. So it's just an additional compliance piece at this point. Similar to that, country by country reporting, which has been around for a few years, but we've got now something new, which is public country by country reporting, which basically means that the multinational groups, their country by country report, which normally would only be submitted to a tax authority, would now be actually available publicly. So we're still waiting on rules and proper guidance on how that's going to happen. But it's definitely coming. I think it's applicable for income years starting on or after 1 July 2024. So it's a wait and watch, but it's definitely something that's going to happen. And those CBC reports for basically are going to be made available for everyone to be able to access. I guess the reason why the ATO wants to do it is because they want to see it goes back to that behavioral tax based system, where they want to encourage taxpayers to ensure that they actually change the way they operate and what their tax policy is, so that they actually pay proper taxes where required. And then it's kind of like when the information becomes public, it does impact the reputation of the company. So they just want to make sure that, that it's kind of seems to be a way in which they're trying to get taxpayers not do any mischief, I guess. And another one that's come out very recently, just a few weeks ago, this is something to do with financing. Again, because there's a lot of Australian taxpayers that are highly leveraged and have a lot of debt, it's been a focus area of the ATO. So there's been some legislative amendments recently, and the ATO has now recently come out with a guidance to tell us what they think should be the right quantum of debt that a taxpayer should carry. And obviously that guidance, it's at the moment it's in draft, it's under consultation, but it's going to provide us with some sort of view on how the ATO would look at how leveraged should taxpayers be. So as I said, it's in consultation at the moment, so will probably be finalized in a few months. So so there's, I guess, as I said, lots happening in this space, and there's always clients that come across a lot of these issues, so it's just kind of important to keep updated with everything that's happening in this space, to ensure that the ATO's expectations are met. We know what risk is being borne by the taxpayer. And yeah, I guess maybe it's probably, I've been talking for a while, so maybe a good time to pause and see if there's any questions. Otherwise, I can go on. I don't know if there's a way to.
There's one question there. Any court case for PCG 2024/1?
Court cases?
Yeah.
No, because the PCG is just a risk assessment tool. There's no court cases on that.
Okay. That's the only question on chat
Yeah,
box.
sure, no worries. I will move on. So I guess we spoke about all the developments in the TP space and all of that. So it's probably worthwhile just seeing, providing a bit of an insight on what we know that the ATO looks at. So how does the ATO actually determine or find out about transfer pricing or transfer pricing mischief? So there's a few sources of information that the ATO uses. Something called an international dealings schedule. So taxpayers with related party dealings of more than 2 million need to prepare this schedule, and it's really just a summary of what sort of related party transactions are there, what sort of documentation does a taxpayer have on record, what's the transfer pricing policy they've applied to come up with the right price to show that it's at arm's length. So yeah, all of that sits in the IDS schedule, which is a very good source of information for the ATO. So they definitely use that to determine transfer pricing risk. There's also country by country reporting. Country by country reporting, it only applies to very large, to entities that belong to a very large group. And we will come to the concept of significant global entities in a bit, but that's where country by country reporting comes into play. But yes, again, it's a similar document that's provided to the ATO, which the ATO then use to determine any risks from a TP perspective. IFRIC 23, so this is if there are any uncertain tax positions that are reported in financials. So again, something that provides the ATO a bit of an insight on if there are very controversial areas or controversial positions that the taxpayer has adopted. Reportable tax positions, again, it's a requirement only when you've got like a large turnover of 250 million. So limited taxpayers get affected by this, but again, another source of information for the ATO. So, and then what we know is that the ATO does have very sophisticated tools, softwares, data analytics, which they use to then get all this information, put taxpayers in different brackets depending on the risks, and then that's when they pick up taxpayers for scrutiny or questioning or things like that, or where they identify specific target areas that they want to publish any sort of guidance in or provide a view on. So all of this information, the ATO has a lot of information. They collect a lot of information. We find that there's a number of different sources of information and a lot of information that's being provided. So hopefully their tools are working well and they're able to use technology to figure this out, because otherwise it's a lot of volume of data. So we might just, so this is a very busy slide, but really what we've kind of done is, based on the sources of information that that's been provided to the ATO, these are some of the risk areas, or these are some sort of the, I don't want to say red flags, but some interesting indicators that the ATO might consider, and then might be like, oh, okay, maybe this taxpayer needs to be scrutinized or questioned in terms of what's going on. So things like low level of transfer pricing documentation. Obviously, if there is a material transaction which doesn't have any documentation prepared, which the ATO can find out from the international dealing schedule, then that's a bit of an indicator that there could be a risk there. International restructure. So if there's been any sort of restructure which may have then impacted the Australian business or the amount of tax that's being paid in Australia, then that's definitely something that the ATO might be interested in. Transactions involving financing, as we discussed, interest expenses, definitely a big area of focus of the ATO. R&D activities, intellectual property, as we saw, intangibles, and the ATO wants to see how much work is being put in developing the intangible property in Australia, and they also want to see the amount of revenue that's being brought into Australia is commensurate with the amount of effort that's being put in. So that's again key area of focus. Dealings with high risk jurisdictions. So obviously some of the lower tax jurisdictions. So when taxpayers do the IDS form, there is you need to provide a country code, so which basically provides an indication to the ATO in terms of what jurisdiction you're dealing with, and if it's a low risk, it's a low tax jurisdiction, then definitely something that warrants more scrutiny. Sustained losses. So again, taxpayers just continuous losses for over 3 years now. Not necessarily that itself is a problem, but it's something that might interest the ATO. That's all. Because you can have losses because of just business reasons or commercial factors and the like. So there can be many reasons for losses, but transfer pricing can be one of them. That's what the ATO is interested. Yep, things like inconsistent information. So let's say you've put there's inconsistency between what says in the financials as against the international dealings schedule or the country by country reporting. So, or in the transfer pricing, so like documentation. So that's what the ATO would consider as inconsistent information, and then they would ask questions about that. High profits, low tax, again, because they've got all this technology and tools, they're able to calculate, assuming like ratios and stuff like that to see, okay, this is a very high profit, but why is the tax paid so low? So the actual tax paid is very low. So again, something that calls for scrutiny. Yep, stateless revenues, again, it's some sort of tax planning and dealing with residency issues, and there might be situations where the revenues aren't being booked in either of the jurisdictions. So obviously there's something that would seem controversial. Type of activity in a jurisdiction as well. So depending on what the jurisdiction is and what the substance of that jurisdiction is, let's say if it's a specified high risk jurisdiction, then that is a bigger red flag from an ATO perspective. So, and these are just really examples of what the ATO could be looking at, picking up from from all the data that's being provided. I guess what we tell our clients, what do we need to do to mitigate the risk if the ATO comes with a review or asking a question, is obviously when you're dealing with related parties and it's a cross-border transaction, you don't want to wait until the transaction is done to then prepare a document that's going to support that transaction. You want to engage with a specialist to ensure that the way that's priced is actually appropriate and in line with transfer pricing principles and the ATO's expectations. So that's the planning phase itself. Once the transactions occurred and after the end of the year, before the tax return is lodged, taxpayers should have the relevant documentation in place. And the documentation, there is an ATO format and a certain structure that they prefer. So that's the documentation that taxpayers need to prepare. Another tool is to do the practical compliance guidance risk analysis, because at the end of the day, PCGs are risk tools. They tell us how the ATO reviews a particular taxpayer's profile as a low, medium, high risk. So that's another way to determine where a taxpayer lies from the ATO's point of view, and then if they want to take some steps to actually reduce the risk profile or improve the risk, sorry, I should say improve the risk profile from an ATO perspective. On-time lodgements, definitely don't want to be in the bad books of the ATO. So ensuring things are lodged on time, tax returns aren't lodged after the due date, things like that. Early engagement, like an APA program. So this is for taxpayers that want absolute certainty. So before entering into a transaction, yes, they can actually enter into an APA program with the ATO. It is a bit lengthy in terms of the amount of time it actually takes, but it does provide a lot of certainty. So there's pros and cons there. So yeah, I guess so to sort of to summarize this slide, the ATO has a lot of information from taxpayers from all the documents that are being provided. They do have sophisticated tools to determine the risk, and there's obviously some focus areas for the ATO. What taxpayers can do in the meantime is to have a right policy in place and have that documented properly, make sure everything's lodged on time. And if an issue is very complex and they want absolute certainty, then engage with the ATO through something like an APA program. All right, so this is just an example. So we've put like this is a PCG 2019/1, which deals with inbound distribution arrangements. So which basically means if there are Australian subsidiaries of foreign head offices and they import goods into Australia, acting as distributors and then on selling, which is very common. And Australia has a lot of inbound distribution arrangements, which is why the ATO came out with the guidance. So what they do with PCGs is it's a traffic light based approach. So they rate low, medium, high risk. And then depending on where a taxpayer sits in terms of its risk profile, the ATO may allocate resources to review those taxpayers. So for example, a green zone, a low risk taxpayer, the ATO might not allocate resources because they're already meeting the relevant criteria from ATO's perspective. For distributors, it's really looking at EBIT margins, but depending on what PCG there is, the ATO has certain parameters and risk assessment tools. I guess wouldn't go into too much detail into this slide, but this is a good sort of provides just an overview of the types of penalties that can apply. Now, we do have here non-SG and SGs, so we'll go to the concept and understand the concept of SGs, but really, as you can probably see, SGs for the base rate is a 500 multiple, which basically means when an SG is involved, you just don't want to be late on anything because the penalties are just outrageous. And every time we tell clients what SG penalties are, especially in different jurisdictions, everyone is just absolutely shocked to see that the numbers are this high. So it's definitely SG's big area of focus, and don't want to get anything late or not lodged. So it's very, very important. And then we've obviously got the administrative and the scheme penalties, which is pretty straightforward, I guess. So yeah, I do want to spend some time on SGs. So traditionally, so the SG rules came in 2016, and then they were amended in 2019. So what we've got on the left side is really the traditional SG, which is what the rules that came out in 2016. Now, all it basically says is if it's a global group, multinational group, very large group, and if there's an Australian entity which is part of that group, and they've got consolidated revenues of more than 1 billion AUD, then they're treated as a significant global entity. And then what it means when you are an SG, one, you need to disclose in the tax return and let the ATO know that you're an SG. If you don't do that, that itself is a misdisclosure and then goes back to all those big penalties. You're subject to the anti-avoidance legislations, so MAL and DPT. There's very onerous late lodgement penalties going up to 825,000 per tax document that's lodged late. So obviously outrageous. And then there are additional reporting requirements, which you may have heard, country by country reporting, which has essentially local file, master file, country by country report, and GPFS. So there's many, I guess, ramifications of being an SG. It's kind of a big deal if you're an SG, and obviously the ATO is really focused on SGs. So one thing is it's important to understand, I guess, where a lot of taxpayers have got it wrong or missed is they didn't even know they were an SG. And that's because it would be a small Australian company that would have been acquired by a global group, and they wouldn't know that they might think, oh, we're very small, but if the global group is very big, you're still within these rules. So it is a pretty onerous requirement. So that's the traditional SGs under the 2016 rules. In about 2019, the ATO realized that they wanted more entities to form part of this SG framework, and they realized that entities that are owned through, let's say, PE firms, private equity firms, weren't satisfying the definition of SG, of being an SG, just simply because of the way in which private equity firms prepare their consolidated accounts. And because they hold these their entities as investments, they get something called as an investment entity exemption, which basically means, let's say a private equity firm has invested in, I think we've got here, Group A parent, Group A. They wouldn't have to record the $700 million of Group A in their accounts as their own revenue. It would sit as an investment in their books because of the investment entity exemption. Now, the ATO realized this and they decided to change the rules, which basically said, ignore the investment entity exemption. So if you're a global group, irrespective of how you account, you just got to consolidate the revenues, and on a consolidated basis, so what they call a notional listed company group, so it's a hypothetical consolidation. On a consolidated basis, if that global revenue exceeds AUD 1 billion, then you're still an SG. So that basically lost count of how many companies didn't know this and have only realized it 3 years after that they were actually an SG because they were owned by a PE firm. So a lot of entities got pulled into this, and a lot of entities actually realized that very late, which put them in a difficult position because they were exposed to all those additional penalties and all of that. So again, very important to know, and I know it's only really very large groups, but just a very important consideration and something that absolutely cannot be missed. Now, there is a distinction between an SG and a CBC reporting entity. So a traditional SG, yes, if it's an Australian entity, belongs to a group and they have more than $1 billion revenue. It's also subject to country by country reporting, CBC reporting, and there are certain documents that need to be lodged with the ATO. However, when we look at, let's say, the same example of the private equity firm, they may not have to actually do country by country reporting. So there are some specific rules around how that operates. But at a very high level, SGE and country by country reporting. So there are entities that can be SGs, but they may not be country by country reporting entities. So when they're not country by country reporting entities, they don't have to do the specific lodgements. So that's where they get a bit of relief there. However, once a group is an SG, you're still subject to those additional penalties and the late lodgement penalties and the anti-avoidance legislation. So irrespective of the country by country reporting, being an SG itself is a pretty onerous requirement. So, however, it's important to note the difference between SG and country by country reporting and how do you determine that. So that's something to do with the investment entity exemption that we just spoke about. So, and there are some other sort of rules and details in there as well. So yeah, I think this slide pretty much provides the whole significant global entity and CBC reporting entity overview. So as we can see, revenue of 1 billion consolidated group is a significant global entity. The notional listed company group is a broader concept, where you've got to look at the hypothecated consolidated revenue across all the investments. So that becomes a notional listed company group, and if that is over 1 billion AUD, then still an SGE. Coming to country by country reporting, there are some exceptions. So not all SGs will become country by country reporting entities. So that assessment needs to be made. And then if it's a country by country reporting entity, then there are specific lodgement requirements. So I guess that's a snapshot of that, and hopefully everyone I know it's a little bit confusing. The rules, the ATO has actually complicated the rules quite a bit when it comes to SG and CBC reporting entity, and we're still there's all these little bits and pieces in the legislation that still cause a bit of confusion whether the entity is in or out. So it's quite an interesting area. Yeah, so I guess just the SG CBC reporting entities, key challenges for us and for taxpayers, what we've seen, identifying entities that get caught amidst these rules, very important, especially when it's private rules, private groups, investment entities, and individuals are involved. Understanding whether an Australian entity is actually controlled by someone, because that's a very important test to satisfy. So, and control is a very subjective definition. So considering that, making sure all the documents are lodged on time if you are actually an SG because of the late lodgement penalties, and ensuring that there are no misleading statements in the tax return. So, and this is like ensuring that it's been disclosed that it's an SG, it's been disclosed it's a CBC reporting entity, and things like those, because even that's quite onerous from a penalty perspective for SGs. I might pause there if there was any questions on this topic.
There's a follow-up from the PCG to 2024/1. Ben was saying he meant any court case for intangible arrangement apart from PepsiCo.
No, not yet. Yeah.
Okay. And I think this is just a comment from Shital. Reportable tax Reportable tax position revenue is 250 mil for Australian entity or group or consolidated results.
It's for
Okay.
the Australian revenue.
Okay.
Yeah.
Perfect.
Okay, so I guess just sort of, I think I've provided a lot of information, and appreciating that transfer pricing is a niche area. Not everyone here may have sort of encountered that yet, but it's very, very relevant and upcoming, and um, just sort of takeaways for everyone. ATO's quite focused on it. If there's any sort of high risk areas that we just saw, ensure that if they've been raised, they've been managed. To manage transfer pricing risk, make sure there's a transfer pricing policy set from the get-go, have appropriate ATO approved documentation in line with ATO guidance. And then lastly, what we saw with the significant global entity rules, again, another very important consideration, and ensure that taxpayers know if they're going to get caught into these rules, because they're very, 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 very onerous and extremely large penalties. So yeah, I guess that's what I wanted to share today. And yeah, as I said, it's a lot of information, and very happy to take more questions either now or even later if anyone has anything that they've come across and they've got any doubts when it comes to any of this stuff.
Okay. If anyone have any question, you can raise them in the chat
Right.
box,
Yeah.
or if you want to ask directly, you can unmute yourself and you can ask Jital directly.
Try to stick to the time as well.
It's okay. Yep, I can't see anything on the chat box. Also, there's no one put their hands up.
That's fine. As I said, if anyone has any questions, you can contact me on LinkedIn. I guess that's probably, or I don't know if my video details have been shared, but yeah, I guess LinkedIn is a good way to connect, and happy to help with any sort of transfer pricing issues.
All right, so that's if there's any other, there's no other question, Henry. Any other thought or any comment before we close the meeting tonight?
It's an area that's completely outside my expertise, and generally speaking, cross borders is very complicated. It's always better to get some advice external to your services, just in case that if tiny little mistakes happen, it might come back and and cost us in the future. It's always better to get some external advice on these part of it, just a very
Yeah.
specialized area.
Yeah, and I think we work with a lot of accounting firms, as they don't have the transfer pricing sort of team expertise. So it's a big part of our practice actually to do that. So yeah.
All right, no worries. So thanks, Jital, for your time, expertise, and insightful presentation this afternoon. And your valuable contribution is truly appreciated. And if once again, if anyone of you need any further information, you can contact Jital directly, and I'm sure she'll be able to help you. She'll be happy to help you and help your client further. So thank you all once again for attending tonight's session, and we hope to see you all back again in a month's time, and we're still running it through online session. And until then, stay connected and stay healthy. Thanks,
Thank you.
everyone.